day, fellow investors. Perhaps the most likely crisis coming in the next months, years, could be a debt crisis. We have already discussed interest rates in a special video, and in this video I want to focus on debt, because a few things don't really add up. First, let us start with the US 10-year Treasury, which is the alpha and omega for valuation, investment and everything. First and foremost, now the yield is 4.5% on US government debt, and it hasn't been that high since the mid-2000s. We have had this artificial, let's say, fake, rigged interest rates market where the Fed, all central banks, led interest rates to zero that artificially lowered all other rates. In the meantime, global debt has ballooned. If we had a debt crisis in 2007, 2008, since then debt crisis has been solved by adding more credit, more debt. And if we look at the global debt in US dollars, and if we look at the percentage of GDP, then we can see that it is just growing and growing. And here is the data since 2000. You can see how those governments have been piling from about 100% of GDP going to more than 200% of GDP. Lower interest rates have pushed the same financial sector that was in crisis here to increase its debt to GDP. Corporations a little bit, especially on pandemic-free money, and households refinancing houses, but just a small tick here. And the thing is that if we look at governments, everyone is enjoying the party of the last 15 years, and nobody wants to stop except for oil-rich Norway, Pharma Denmark, Switzerland, and okay, Japan is something completely different that we will also discuss. But if we look at US, Italy, percentage of government revenue, net interest expense is now 7% of revenue is just on interest, which is insane. And you might be thinking, Sven, what's the point of discussing this now? Everything looks good, the economy is growing, everything great, right? Well, let me show you this. This is perhaps the most important debt chart one has to see. This is Greece credit level. You have here how many levels it is above junk. So it was 5, 6, Moody's, 6 levels above junk till August of 2009. Greece had a credit rating 6 levels above junk till August of 2009. Only then the market reacted, and then it was in default. Then Moody's went 11 levels below investment grade. That is insane. And the change in credit ratings is what really baffles me, and is perhaps the key factor you have to get from this video. Everything is great until it isn't. As they say, you go bankrupt gradually, then suddenly. And you think that, okay, what does that mean? If we look at the gross domestic product of Greece, since this is 2004, it was higher than it is now. That's almost 20 years of absolute destruction. And yes, look, when they were taking all these debts, everything looked great. The GDP, there was an explosion. And now the same is happening in the US. Great deficits, the government is borrowing, the economy is growing, everything looks great. However, these deficits come due at some point in time. If we look at this chart, it's insane of the US government debt and its explosion. However, perhaps even more important when it comes to debt is the following chart. If we look at debt to GDP, this was around 30% here, now 123% federal debt over time. There are various measures, but okay, here we are, and you can see how it is piling. This is driving the economy, and the expectation is that the debt will just continue to grow at 6-7% of GDP forever, according to the Congressional Budget Office. So if we look at the long-term budget outlook over the next 30 years, if we look at their projections, which are linear projections, no recession, no craziness, no natural disasters, no pandemics, nothing. Linear projections, all is great. Then if we look at that, the deficits will maybe stabilize a bit, but then keep on growing as net interest goes from 3% of GDP to 6.3%. We are all aging, whether you like it or not, except my wife, she's always the same and beautiful. But if we look here, mandatory spending, Medicare, Social Security, all going up faster than GDP. And if we look at GDP growth, it's expected to be good, constantly 1.8, 1.8, 1.6, 1.6. But GDP growth is driven by consumption, and government spending also is adding, the deficits are adding to that GDP growth. What if we have a few recessions every decade here, and look at the unemployment rate expectations in the linear projections? Unemployment never, ever goes above 5%. Let me show you real history. 14, 10, 6, 7, 10, 9. So again, the projections are made assuming we have no recessions ever. But if things start to deteriorate, then everyone, they just quickly change their projections. And this is the issue. This is gradually, then suddenly. And for now, nobody cares. Nobody cares. It's insane how nobody cares about the deficits. And look at what happens when you have too much debt. Europe took a lot of debt in the early 2000s. Since then, things have stabilized. And if you look at growth, it is, let's say, subdued. It has been subdued for a while. Compared to the US that went from 30% debt to GDP to 120, of course there is huge economic growth that aids to that debt, but it is a big difference whether you are borrowing too much, because at some point you might pay for that borrowing. The thing is that everything there is projected to cost more and grow. The costs are projected to grow faster than GDP. As Ray Dalio says in his recent letter, the fundamentals are weak. The long-term fundamentals are currently reading 100% risk. And if you check his latest letter, the short-term fundamentals are reading 0% risk. So everything looks great in the short term until it doesn't. He also says in the recent interviews that it might change in the next few years. And this is nothing new. We have discussed Stanley Druckenmiller. So America is eating its seed corn at the expense of future investment. At some point, interest rate costs become too high. That is at the expense of future investment. And then you see, at the expense of future investment, everything changes, credit rating, everything. And Druckenmiller calls it directly the coming fiscal horror show. Because here are the Social Security, the major healthcare programs, the fiscal balances also depend on interest rates. And if interest rates are managed low, interest payments will slowly and gradually rise. But if there is a crisis, then interest payments might grow even faster. This is again all linear projections from the CBO. Here we have a different. Why it is so important to have deficits at 3% of GDP. Like now, Europe has stabilized, and that's why Europe sees no economic growth. The US is booming, and there is also economic growth. Now, 3% deficit is okay because when you calculate inflation, everyone expects it to be at 2%. Real inflation is 3%. Here, let's say 5%. So 5% inflation means that also government income grows by 5%. And then you can grow debt by 3%, and you are still lowering the debt to GDP ratio. So 1% plus 2, 3%. And that is the benefit of K. At 3%, deficits are even okay. 7%, it's a little bit stretched. But Ray Dalio says, let's do it now, let's bring down deficits to 3 now, and do it now counter-cyclically when the economy is doing great. Solution: taxes or spending cuts. So somebody has to pull on the brakes now that everything is doing great. Yes, there is the dodge, but this is okay, 36 billion in savings, and we'll see how that goes there. But 2 trillion target, and how can you save 2 trillions when, if you look at the deficit, when you just look at 2 trillion of spending, non-defense discretionary is 1 trillion. So you must then go into other things, but other things then impact also the economy and everything. And that is the vicious debt cycle. You can start cutting, but then you're also cutting growth. Then you have to cut more because the growth isn't compensating, things like that. Therefore, this is why there is this debt weak fundamentals. Now it's 0%, which means in the short term we might be here if we compare it to Greece, but in the long term, if nothing changes, we are here, and that leads to very, very difficult situations. Yes, miracles can happen, AI, increased productivity, savings here and there, but betting a country's future on miracles is something a value investor would say it's not wise to do. The next crisis might really be a debt crisis, and the sooner it happens, the better, because the sooner we will tackle all these issues from a global developed markets perspective, because there is also demographics. You can lower rates, you can try to artificially lower rates, but that is something. The next step is, of course, if you don't want to increase taxes, lower spending, just print more money, which leads to inflation, and we are already seeing inflation here being stubborn. So I have no idea what will governments do, whether that situation will be tackled. I know that just month after month the risks are piling, and at some time those risks will reach a tipping point. Everyone will start talking about those, and then the spiral of the risk exuberates, and then that is when those ratings change and everything. Perhaps a recession, something might trigger that, but I know that interest rates might get out of control. We don't know what will be the reaction of the governments. More inflation, inflationary spiral. News are all short-term, and these are the things that we discuss here on the channel that are long-term. This for now on the debt. We will continue discussing these topics as we have discussed interest rates. I'll put the links in the description below. We have to discuss inflation, economic growth, demographics, and a lot of these topics that paint a picture for the long term.